So this now is going to start our Financial 15 section. So we're coming off of the weekly webinar, and we just spent several minutes talking about updates, IRA distribution updates from the Ed Slott group. Some really good stuff this week. One very good cheat sheet about requirements for inherited IRAs. We talked about the markets, some market updates, some analyst reports, and we talked about the change of our schedule to Wednesdays from Tuesday weekly webinars. And now in the Financial 15, this is typically a financial planning topic, and this is definitely a financial planning topic or strategy that that we hope will help you move forward in your financial plan and how you're thinking, and maybe open your mind to different things. But we're going to talk about the proposed end of backdoor Roth contributions. So let's talk about this a bit. We're first going to talk about what is a backdoor Roth contribution. I don't know why. I had a conversation with our friend Sarah Brenner from the Ed Slott group about this, but for some reason, this has recently been referred to as a backdoor Roth conversion. If you see backdoor Roth contribution or you see backdoor Roth conversion, they're the same thing. The phrase backdoor Roth conversion kind of sticks in my head a little bit because, or sticks in my craw a little bit because it's not a backdoor Roth conversion. You can do a Roth conversion. We have it. You can convert as much or as little as you'd like. Income doesn't matter. There's no reason to backdoor a Roth conversion. There's no such thing. But there is a backdoor Roth contribution because there are some requirements and limitations on who can make contributions to a Roth IRA. So the mechanism we're talking about is a backdoor Roth contribution. It allows you to make contributions to a Roth IRA if you've earned what the government considers, or what the tax code considers, too much money. So let's just talk about that for a second to give you a foundation. But I just want to say again, if you read backdoor Roth conversion, backdoor Roth contribution, it is the same thing. It's just being used the wrong way if they're saying backdoor Roth conversion. So we're going to focus here, and this is what I'm referring to here is a 2024 plan contribution limits. And again, you can download this from our website. If you go to attleborowealth.com, it's over here, attleborowealth.com. You go to the slot corner, scroll all the way down to the bottom, put in your email, and you can download these tax planning forms. One of them is the 2024 retirement plan contribution limits. So I'm going to go down here to the bottom left of this form, and we're going to look at 2024. So for a married filing joint person, taxpayer, this is based on modified adjusted gross income. But remember, not including Roth conversions. This is important. Remember, I did a video about, hey, that CPA got it wrong, and it happens just about every year when somebody comes in and says, hey, you did contributions for our client, and you shouldn't have because their modified adjusted gross income was too big. But this modified adjusted gross income does not include Roth conversion. I just realized that you can't see what I'm writing. There is an exception for Roth conversions in this modified adjusted gross income calculation. But if you have modified adjusted gross income that doesn't include Roth conversions, and you're a married filing joint person, and your modified adjusted gross income is greater than $230,000, all the way up to $240,000, you're in this phase-out range. So phase-out simply means that you can make less and less of a contribution into your Roth IRA. And once you reach over $240,000, you're out. You can't do any contributions. I'm saying contributions, not conversions. This only applies to contributions. But if you're over those phase-out levels, you can't make any contribution, or you make less and less of a contribution into your Roth IRA, and it's a formula. And then once you reach over $240,000, then you can't contribute at all. And if you're single or head of household, obviously your thresholds are lower. It starts at $146,000 for this year, and it tops out at $161,000. And you can see the previous year. So the good news is that this does adjust for inflation. So from 2022, the top phase-out level has gone from $214,000 to $240,000. So you'll see these adjustments for time. over time. But for many years, people have been taking advantage of an allowance in the tax code referred to as a backdoor Roth contribution. So what does that mean? Simply put, remember, here are your buckets. We've got your taxable bucket. We've got your tax deferred bucket. And you've got your tax advantaged or tax-free bucket. And we're going to focus on the Roth here. And in your tax deferred, we're going to focus on IRA here. And your taxable is, remember, this can be your money markets, your CDs, your mutual funds, your stocks, anything that is not a retirement account, or whether it's Roth or individual, traditional. So anything that is not retirement account is what we refer to as taxable. But we're going to focus on IRA. So we said that if you make too much money by these guidelines, as told by these guidelines, then you can't make contributions. And also, as a single filer here, you can't make a contribution to a Roth IRA. But you can make conversions. Or no income limitations on conversions. So what the current tax code allows for is, hey, you can make a non-deductible IRA, traditional IRA contribution into your IRA. And then, since you don't get a tax deduction, you've already paid tax on that money. It could either come out of this taxable bucket or out of your earnings. It doesn't matter where the money comes from. It's going into a non-deductible IRA, right? Non-deductible IRA. So you can't deduct it. And then you immediately move that money over to your Roth via Roth conversion. And now it's just like you've made a contribution into your Roth IRA. Very, very simple. There are, of course, some things you have to watch out for. You have to be aware of the pro rata rule. So if the pro rata rule says that this is fine if you don't have any money in an IRA, you can move that whole. Let's go back to this chart. Let's use the allowance that we can put into IRA or Roth IRA this year. So assume you're over 50. Let's use the over 50 catch up, because this year in 2024, remember, it goes up every year typically. Just like I explained to you, the phase out levels, your contribution levels also increase. So if you're under 50, you can put in $7,000. If you're over 50, you can put in another $1,000 for a total of $8,000. Let's assume that you listening are over 50. Now you've put in your $8,000 into your Roth IRA. Write it in here, $8,000 into your Roth IRA, and you've sent that, your traditional IRA. You've made a non-deductible contribution of $8,000 into your traditional IRA, and you've then converted it immediately over to your Roth IRA. So now the $8,000 sits over here in your Roth IRA, same effect, just like you deposited it directly. You just took that extra step. But the pro rata rule says, well, not so fast. If you have money in this Roth IRA, your traditional IRA, let's say, for example, you have $100,000 in this traditional IRA, then only a portion of the amount that you transfer over to the Roth is going to be a tax-free transfer. The other amount is going to be considered a taxable conversion. Because remember, if the $8,000, and I know it gets a little cloudy here, but let's go here. Let's just bring it down here. So we have traditional and we have Roth. You're depositing $8,000 into here. Don't wait. You immediately move it over to here so you don't earn anything in that traditional IRA. But you've already paid tax on this money, this $8,000. This is after tax. That's important. That's an after-tax amount of money. And the current tax code says, well, heck, that's okay. This is after-tax money. You've already paid tax in it. Now just move it over here, put it into the Roth. But if you've got, as I said, if you have $100,000, and that only works if you have zero balance in here. If that's not the case, if you don't have zero balance in there, and let's say you have a $100,000 balance in here, then you've got to use a pro rata rule. You follow the pro rata rule, which pro rata means loosely percentage. So we have to take the $8,000 and we have to divide it by the 100,000. So that gives us 8%. Now we have to take 8% of the $8,000, and that gives us $640. So only then $640 transfers over tax-free, remember, because it's after tax. The tax code says now the remaining amount of that $8,000 is now a taxable conversion. So I've gotten into the weeds a little bit about that with the pro rata rule, but you got to pay attention to that pro rata rule to make sure that you understand the what you're getting yourself into. But that is the backdoor Roth contribution. Again, conversion doesn't make sense, backdoor Roth conversion, because you can do a conversion anytime. You're backdooring that contribution through the tax-deferred IRA directly to the Roth. So let's just do that one more time. You're backdooring it here. Okay, makes sense? Hope that makes sense. Now, let's talk about the proposed changes.